The reverse repo facility at the Federal Reserve has just dropped to $1.57 trillion for the first time since March of 2022, and it is likely headed much lower very soon. So what does this mean for you, and what does this mean for the markets? Well, very simply, it means that this pool of money that the government has to draw on for borrowing is very quickly drying up, and once it's gone, could send short-term interest rates surging much higher. If you don't know who I am, my name is Joe Brown. I run Heresy Financial University, where I teach active investors how to get higher returns with less risk by learning how markets work. If you're tired of losing money, link is in the description below. So to understand what's going on here, we have to start off with the government's fiscal situation. This fiscal year, the government has taken $3.68 trillion in taxes. That is down 10% from last year. At the same time, they have spent $5.3 trillion, which is up 10% from last year. The difference is called the national deficit, which is currently at $1.6 trillion, which is up 122% from last year. The national debt has reached $32.9 trillion as a result, and it is growing very quickly. Now, in normal circumstances, the United States over the last couple of decades has borrowed from three main large sources. Number one, the Federal Reserve. Number two, China. And number three, Japan. This borrowing is done indirectly, meaning the government borrows from financial institutions, and those financial institutions then sell that debt to other entities like the Fed, China, and Japan. Over the last 10 years or so, this borrowing has been done at interest rates that are very attractive. And during 2020, they were borrowing for 30-year loans all the way down at 1.3%. However, this trend has changed, and those big three lenders, China, Japan, and the Fed, are no longer lending new dollars to the United States government. In fact, they're doing the opposite and allowing most of that debt to get repaid without rolling it over again. With China, their holdings of US Treasuries are now at the lowest level they've been in 14 years. And while the Federal Reserve's drop in holdings of US Treasuries is not as dramatic, we can see that their balance sheet has indeed been reduced. And it is currently sitting at the lowest level it's been since July of 2021. Clearly, the US is not slowing down on its borrowing right now. This means that they are being forced to find other areas of the market and the economy to borrow from. As a result of there being less demand for this government debt, in other words, less money available to loan to the US government, the government is forced to pay higher and higher interest rates in order to entice new lenders. To borrow for 30 years, they're paying 4.29%. To borrow for 10 years, they're paying 4.18%. To borrow for 1 year, they're paying 5.4%. And 6 months, 5.5%. Now, you might be looking at this rate of 5.5% for 6 months and thinking, hey, that looks pretty good. Why is there not more money rushing into this? And the answer is because there's something almost just as good, and that would be the reverse repo facility at the Federal Reserve. So what is this reverse repo facility? How does it work? And why is it in some cases even better than loaning to the US government? To answer this, we have to go back before the Great Financial Crisis. See, the way that banks used to work is they have both assets and they have cash. Now, at the end of the day, they need to pay their bills. And so they would look at their own accounts and say, hey, we need to pay some cash out, but we don't actually have enough cash. Now, we do have assets. So I'm going to take my asset here and I'm going to go out to any other financial institution and say, hey, bank, I've got an asset. You've got some cash. Can we swap? Can we trade this asset for this cash? And then we trade with each other. Now, I have the cash that I need, and that bank gets the asset. Now, we say we have an agreement with each other, and I say, hey, tomorrow or in a week or a later time, I'm going to buy back that asset from you. So I'll give you cash back for that asset. This is a repurchase agreement because I'm promising to repurchase that asset from you. This is a pawn shop. Make no mistake about it. That's exactly what is going on here. So in normal environments, there's enough cash and enough assets in the system for this to happen between banks. And of course, there's an interest rate paid on this as well. Well, during the financial crisis, all of the assets that everybody had were mortgage-backed securities. And so once once the banks realized these things were hot garbage, nobody wanted to accept those as collateral for cash anymore. Everybody needed the cash, but nobody had the assets that were worth anything that other banks wanted. This caused the repo rate to spike to the point where banks couldn't pay it, couldn't get cash. It caused Lehman Brothers to fail, and it was about to spark a collapse of the entire banking system. Federal Reserve stepped in and offered to be the one to inject the cash into that system, since none of the other players had the cash they needed. Fast forward to September of 2019. This is a chart of the repo facility at the Federal Reserve, and you see it was not being used prior to September of 2019, and it was not being used after 2020. And this right here is a chart of the interest rate being paid for cash in the repo market. You can see in September of 2019, that repo rate spiked. This freaked out the financial system because everybody thought there might be bad collateral in the system again, just like during the financial crisis. Turns out that wasn't the case. There was just a lack of cash. So the Federal Reserve intervened again and became the one to inject cash into the repo market so that those rates would stay low. Now, up to this point, we've been talking about the repo market. This is what banks use when they need to access cash. But in the aftermath of all of the money printing that happened in 2020 and 2021, there was a different problem. There was too much cash, not enough collateral to offset it. So banks do the exact same thing. Instead of trying to get cash in the repo markets, they use the reverse repo markets to try and get collateral. This is where I'm offering cash to other financial institutions trying to buy collateral. And as of April of 2021, the Federal Reserve entered the reverse repo market as well. They began paying above market rate interest rates on the cash in their reverse repo facility and continued to increase what they paid along with their hikes in rates to continue to attract cash into their reverse repo facility. As a recap, the reverse repo facility at the Federal Reserve is where financial institutions take their cash, they give it to the Federal Reserve in exchange for collateral. And as an award for doing so, they get paid an interest rate on that cash. Currently, the rate the Federal Reserve is paying is 5.3%. This is the only place to get a risk-free return on your cash because it's coming directly from the Federal Reserve's money printer. With the US government, if you invest in treasuries, buy T-bills, these are things that are theoretically risk-free, but you still always have the risk that because of political gridlock or because of a government shutdown or something due to political factors or otherwise could cause the government to default and choose or be unable to pay back that debt. But anything from the Federal Reserve comes directly from the money printer by people who are unelected. This is literally just a click of a button, happens automatically. And this risk-free rate of 5.3% is currently better than anything you can get from the US government, which carries risk over 2 years. Now, the direct use of the Federal Reserve's reverse repo facility is for financial institutions only, but individuals can get a piece of this action as well through something as simple as a money market fund. Take, for example, Fidelity's Prime Money Market Fund, symbol SPRXX. The current rate it pays is 5.05%, and they're able to do that by using some of the assets in the money market fund to enter into reverse repurchase agreements. When looking at all the potential ways to make money, investors are always weighing the balance between the risk and the return. So currently, the risk-free rate is somewhere around 5 to 5.5%. You can get a tad bit of a higher return by loaning your money to the United States government for a short-term loan. But you don't take that much of a hit on your return by taking the completely risk-free option of going with the Federal Reserve's reverse repo facility. By the way, guys, I'm doing a silver giveaway, hundreds of dollars worth of silver for the Silver Symposium in Vegas from September 29th through October 1st. First place prize is getting this 10-ounce silver round. It's an Australian kookaburra, beautiful 10-ounce piece here. Second place gets this 10-ounce bar, not as pretty, but still 10 ounces of silver, so hundreds of dollars here. Third place prize gets this 1-ounce silver round. It's plated with gold, and it has this nice little Bitcoin design stamp stamped into it. So pretty cool. So what do you have to do to get the prizes? Number one, you have to sign up for the event with the ticket link in the description below. Number two, you have to meet me in person. The first person who signed up with my link, who meets me there in Vegas, gets this first place prize. Second person to meet me gets the second place prize. Third person there to meet me gets the third place prize. So get your tickets in the link below. Just a couple of weeks left. Can't wait to see you there and give away these silver prizes. So that's the situation with the reverse repo facility. So how does this connect with the US government's fiscal situation? Well, all things being equal, if the government has to borrow more, it's gonna push interest rates higher. This is because there's more supply of debt hitting the market that pushes prices down. That's interest rates going up. That's exactly why interest rates have been going up over the past couple of months, because the United States government has been borrowing so much more recently. And you're gonna be shocked to see exactly how much more the US government has been borrowing very recently, how fast it's been accelerating. If you go to fiscaldata.treasury.gov, you can see the data set of the national debt to the penny. The most recent figure of the national debt is $32.9 trillion as of August 31st, 2023. If we scroll down to get to just 90 days ago, May 31st, 2023, we see that figure, the national debt, was $31.464 trillion. Doing some quick math, we can see the difference in the national debt is $1.45 trillion. In 90 days, the national debt increased by almost $1.5 trillion in 3 months. As a result, interest rates have been inching higher. But why have they just been inching higher? Yes, 5.5% right now is better than the 5.3% in the reverse repo facility. But you'd imagine that they should be much higher than that. Well, let's walk through a short little thought experiment. Let's say the interest rate on the 6-month gets up to 6%. Well, suddenly that's a way better deal than what you could get in the reverse repo facility. So they offer 6%, tons of money comes in to buy up that debt, but there's not enough supply for all that money, so it bids up the price of that debt that's being bought, which pushes down the yield, the interest rate. And then suddenly it's back down to about market rate where it's at right now. So all else being equal, as the government has to continue borrowing more and more, yes, it would naturally have an upward pressure on those interest rates. But there's $1.57 trillion getting paid 5.3%. So every time government debt pays a little bit better of an interest rate, it's gonna attract a little bit more of the money that's in the reverse repo facility. In short, the more the government borrows, the faster the reverse repo facility gets drained. But there is still $1.5 trillion in this facility, which is $1.5 trillion the government can borrow at right around current rates. So this $1.5 trillion is acting as somewhat of a buffer, a cushion for the US government to borrow from. So a big question on people's minds right now is how long will that cushion, that buffer last for? Well, at the current rate, the government has just borrowed almost $1.5 trillion in the last 3 months. Over that same time frame, the reverse repo facility has drained from 2.2 trillion down to 1.5 trillion. So about $700 billion has gone from the reverse repo facility and drained out to debt markets. These are rough numbers, but this is roughly half. So at the current pace of government borrowing at $1.5 trillion every 3 months, and with about half of that coming from the reverse repo facility, that puts us on a timeline of about 6 months from now until this facility is drained, which means that short-term rates probably won't be able to move substantially higher over the next 6 months until that facility is empty. And now consider what will happen when it is empty. No more cash on the sidelines, being paid a risk-free rate by the Federal Reserve, waiting until the government offers a little bit of a better return. Just like happened in the financial crisis and just like happened in September 2019, there will be a cash shortage again. A borrower entering the market with unbelievable appetite for borrowing and no more cash left at the current rates to draw from. This could push short-term interest rates unbelievably higher. And the worst part of that is that it's an exponential problem that feeds in on itself. This is a chart of the interest payments on the federal government's debt. At the end of 2021, this number was only $600 billion, and it has since surged to $900 $169 billion. The conservative estimates are that in the next 2 years, this number will be $1.5 trillion. This does not replace Medicare spending. This does not replace Social Security spending. This does not replace military spending. This is in addition to all of the spending that the government is already doing. It's not going to infrastructure. It's not going to education. It's not going to healthcare. It's not going into your pocket. This is just interest payments on the debt. The higher this goes, the more they have to borrow in order to pay it. Now, here's exactly what's going to happen as a result of that. There will be a liquidity crisis. This will, in fact, suck all the cash out of the system. And what does a liquidity crisis always require? Intervention by the Federal Reserve with a resumption of quantitative easing or a reduction of interest rates. Only this time, it's going to be the federal government that needs that bailout, not the economy like last time or the banking system like the time before that. Bottom line, watch the reverse repo facility. This is called the Overnight Reverse Repurchase Agreements at fred.stlouisfed.org. You can find it by going to fred.stlouisfed.org. Search reverse repo and you'll find it on the first option. When this facility gets down close to zero and short-term rates start to surge, and you know it's about to hit the fan. And by the way, earlier I mentioned Fidelity's purchased money market fund, SPRXX. And just in case you're wondering about that, number one, there are these purchased money market funds everywhere. In every regular brokerage account, you can find these and they're all going to be paying somewhere around that 5%. Banks can't pay this rate right now because they still have losses locked in from buying debt last year and the year before and the year before that at crazy low interest rates. But money market funds are liquidity driven funds, which means that they were never buying 30-year treasuries at 1% or even 10-year treasuries at 0.5% like banks. They only buy the extremely short-term stuff, which means that it constantly rolls over and they get to take advantage of a rising interest rate environment, unlike banks. A purchased money market fund that invests in things like the reverse repo facility and T-bills that pays 5% or higher is certainly a fantastic piece of your cash portion of your portfolio. Because in every investment portfolio, you're going to have a allocation to cash. I wouldn't suggest using a money market fund for your entire cash allocation, but it can certainly be a very useful piece of it. And I go into this and T-bills and much more in extreme detail. My brand new course that's coming out very soon on cash management for all members of Heresy Financial University. For all the members, you obviously are going to get immediate access to this as soon as it is launched. Automatically, you don't have to do anything. For anybody else who wants access to this course and every single other course that I've published, sign up for Heresy Financial University. Link is in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.